For those who are starting out, the decision making might be somewhat easier if you haven't got costs to pay to start operating through a company. At which point, I think it would be quite useful to just cover some basics of operating through a company. So if someone's setting out, what do they need to be mindful of?
Well, if you've never run a company before, it's really important to understand that a company is a separate legal entity. It's not actually an extension of yourself. It has its own legal definition. You will have lots of extra requirements with a company. You have to prepare statutory accounts. You have to submit accounts and confirmation statements to Companies House. You have fiduciary duties as a director of a company. And you can actually have criminal proceedings against you, which you obviously wouldn't have as an individual, by just failing to submit your accounts and meet the company requirements. So there's a lot more involved in a company from that perspective. But in terms of tax, it can be quite a useful tool, because you won't be paying income tax or capital gains tax, you'll be paying corporation tax. Now, up until very recently, that was the big bonus, because you'll be paying tax at 19% regardless of the profits. But obviously corporation tax is now at 25%, unless you're in the small profits rate, which is below 50,000, you can remain paying 19% tax. You can fully offset the loan interest, so you don't have any restrictions on loan interest. So you can get a full deduction against the profits of the business. So unlike the example that Tom just gave you, you wouldn't be showing a profit in that scenario, you would be showing a loss, so you wouldn't be actually paying any tax. You have an extra step to go, though, if you want to extract those profits from the company, because in the company owns the property. The profits of the company are the company's profits. And if you, as a director or shareholder, either want to pay yourself a salary or you want to take a dividend, you have to extract that from the company. At that point, you will incur additional taxes. However, if you want to reinvest and grow your portfolio, then you can stay just paying the 19% or the 25%, and then you can reinvest. And if you reinvest and not take the profits out of the company, you won't be incurring what we've generally referred to as a sort of a double taxation, which is the corporation tax and then the income tax element from taking the money out of the company. I don't know how many people are familiar with what we call ATED, which again is another fairly recent, well, it's probably not that recent, it's a charge from the government from companies that own residential properties. But these ones, they do have reliefs and exemptions, because ATED's quite a nasty tax charge. But they do have relief and exemptions as long as you're fully letting and that property, and that the director or the shareholder or anybody associated, connected with the director or the shareholder is not living in that property.
So ATED was brought in because there was quite a bit of stamp duty avoidance, particularly with overseas interest acquiring property through companies. So if you're buying shares in a company, you're paying 0.5% stamp duty rates. So it stands for annual tax on envelope dwellings. The envelope dwelling is an artificial ownership. But the point to be mindful of for those who aren't doing anything artificial is that there's still a reporting requirement, because you actually have to claim a relief from this tax, because otherwise it applies. So if you overlook it, you miss the opportunity to claim a relief. In theory, a taxman can come after you for some quite hefty tax charges. So again, something else to be mindful of. Companies present some opportunities for us as tax advisors, again, in planning in a number of ways. So would you mind talking us through a few of those?
Yes. So again, as a director of a company, you are you can be employed by the company, so you can take a salary. The company can also pay into your pension. So you will have these types of relief that you can get from the you'll get full corporation tax relief from payments into the pension scheme. And also what's coming up a very good for any company is the electric cars. So electric cars get a full tax deduction, and the benefit on the director or employee is about 2%, but going up to 5%, if I've remembered that correctly.
I think it's 2% this year, going up 1% per annum for a few years.
Yes.
So we'll get to 5%, but it's pretty negligible.
Yes.
So opportunities for those who are minded to buy electric cars. I've got some clients who bought £70,000 Jaguars for a company and got wonderful tax relief, and they pay very little in the way of tax.
So very good if you're in the market for buying an electric car.